The price of oil is coming off its best week since October, but you still have West Texas Intermediate, the American benchmark crude, sitting below $60 a barrel. So, can the large cap energy stocks still make money at these levels? Joining us now to discuss is Bill Selesky, senior analyst with Argus Research. Bill, welcome to the program.
Yeah, thanks, Greg. Thanks for having me on.
We got a great subject here. A lot of Canadian investors care a lot about the energy patch. Let's talk about the general health of the energy sector right now.
Well, I would say at best it's mixed. When you look at oil prices, you just mentioned $60, around $60 for WTI, did down 16 to 17% on the year, and that's basically pressuring producer cash flows. On the opposite side, natural gas prices are up, close to 200%. So you have some positive feedback on natural gas prices. But when you look at the overall situation in the energy environment, demand is steady, but it's not accelerating. Non-OPEC supply is balanced. OPEC plus supply is not balanced. It's oversupplied, and that's why you have weak prices in WTI and Brent. On the positive side, cost inflation has been easing, which is helping margins, but you do have cautious capex spending by most of the E&P and energy companies, which they have been doing now for the last 6 to 12 months. So that's the positive side, cost inflation. Also, on the infrastructure side, utilization rates actually very healthy. Pipelines, LNG exports, refining, all doing very good. You're seeing strong returns as far as shareholder returns go, both dividends and share repurchases. So the fundamentals seem okay, but not great. But what I would say is, if you want to classify this, we would say that the energy environment is neither sick nor is it booming.
Okay, neither sick nor is it booming. We take a look at the latest earnings season. What are your big takeaways from that, given that kind of backdrop for these companies?
Takeaways, I would say, on big oil actually did pretty well. The companies that we follow coverage beat production guidance by about 2% higher on the production side. CapEx spending down 2% versus plans, and that was a positive. Cash flows up 7-8% versus internal plans, which is good. As far as the big oil guys, guidance on production to 2025, no change there. Basically flat to up minimally. They are keeping CapEx lower. They have been cutting it going forward. And basically the way they still produce profits is basically through efficiency gains. So they're performing well on that side. And the one thing I would say is going forward, as far as the producers go, they're pricing in WTI at about $58 per barrel. That's what they're forecasting in the fourth quarter. So a couple of dollars below where we sit today. So that just tells you that the producers out there are fairly cautious going forward into the back half of 2025.
Even with the cautious sort of price assumption of $58 a barrel, I find it often fascinating what investors, when they get excited about energy companies because crude is skyrocketing, but then what these companies themselves can make money at. $58, how do they handle that level of crude?
Well, they're adapting very well. You'd be surprised. And actually, the biggest way they get there is through capital discipline. What that basically means is they're cutting CapEx, anywhere from 5, 10, 15% versus what they had done last year. So they have that flexibility to do that. The other thing, as far as projects go, they're prioritizing high return, short cycle projects, what actually gets them a big bang for their dollar. So that's what they're doing now. So it's shorter cycle, high return projects. We're also seeing a lot of cost improvements throughout all the big oil companies. They're renegotiating service contracts. They're deploying automation, digital, where they need to. And also what you're starting to see is portfolio reshaping. A lot of these companies are selling off non-core assets, selling it to other people, getting proceeds, reducing their debt. They are hedging production going forward. They are using derivative contracts to hedge production, and there's also some M&A value. We've seen over the last, 12 to 18 months, some of the bigger companies buying smaller ones with the idea that they could use their assets to provide additional resources for themselves. And most of the time, when they come in, they could actually produce that barrel of oil cheaper than the company they actually acquired it from.
So they're working through what you called a sort of a mixed environment in the energy space as we get closer and closer to 2026. What are some potential catalysts for the energy space?
Well, I think the biggest catalyst going forward would be the rebalancing of supply. We had the IEA come out recently and said that they expect 2026 to have a 4 million barrel per day oversupply. And that's basically through OPEC Plus policy. OPEC Plus is unwinding a lot of the production cuts over the last 12, 24 months. And what they're doing is they're supplying oil into a market that's already oversupplied. That's why you see pressure on the price. Other potential catalysts, demand improvements. We keep hearing good things from AI demand, data center growth. That entails energy. That's actually a good thing. The news flow on that should continue to be good, the back half of this year into 2026. We also believe M&A for portfolio consolidation is still a legitimate factor going forward. We'd like to see U.S. export policy clarity as far as LNG permits, pipeline approvals, offshore leasing. We think once we get clarity on that, that would be a big positive for the industry. And, you never know when geopolitical landscape is going to change, whether it be the Middle East, Russia, Ukraine, sanctions. Those things tend to move all over the place, but they actually do have an impact on the price of oil and the way energy companies perform.